Hello, everyone, and welcome back. I'm Joe Trovato, and it is Tuesday, August 16th. And each week we issue new insights that will positively impact your real estate business. Now, last week was a wild ride on Wall Street, no doubt about that. We had the downgrade that led to the volatility in the Dow, and what we are going to talk about today, and that is Bernanke and the Fed statement that rates will remain low until mid 2013. This was viewed by many as a good thing, but what does it really mean to you and I, those of us who are in real estate, in housing, in mortgage financing in Georgia? And today's first insight, I believe, is the most important, and we should be out educating our buyers, sellers, and referral partners of this point. And this insight is that the Fed funds rate does not drive mortgage rates. Again, the Fed funds rate does not drive mortgage rates. Mortgage-backed security bond prices drives mortgage rates. But here's what's happening right now. Lots of people are hearing on the news that the rates will stay low for the next 2 years, and they automatically believe and think that that means mortgage rates, and that's simply not true. But when buyers and sellers hear this and think that rates will remain at current levels for the foreseeable future, they are less likely to act and more likely to stay on the sidelines and sit on the fence, which is detrimental to you and I in housing and not good for the housing market, because what we need to get it back on track is transactions. So I want you to use this information to help your buyers to understand why now is a huge opportunity. So what exactly is the Fed funds rate, and what are they talking about? Well, the Fed funds rate is a rate that is set by Bernanke and the Fed that banks charge one another for short-term loans, 24 to 72-hour notes, when banks lend money back and forth. Now, a lot of people believe that when this rate is low, it's supposed to fuel the economy by helping business and ultimately lead to job creations, which is all great things. So when Bernanke and the Fed say rates will remain low, really what they're telling you and I in housing is that we can expect for the next 2 years to look a lot like what the last 2 years looked like. So, forgive me when I don't get excited when the Fed says, you can expect the same over the next 2 years. But here's what it looks like. Here's the reality and the facts of the matter. In December of 2008, that was the last time Fed moved rates, and they moved them from 3/4 to 0.25. And it has remained at this level for 2 years, and they're saying that it's going to remain at this level for the next 2 years. So let's look at what went on with mortgage rates. Okay, over the last 2 years, the same time period, you can see mortgage rates spiked 5 times and hit levels of 5.25 or more. And here you go. It's 1, 2, 3, 4, 5, and only hit the all-time lows 2 times. Once last November of 2010, it hit 4.25, and here recently, with all the volatility in the market, the huge benefactor and the gigantic opportunity that was created is extremely low mortgage rates, and you can see that right here. And you can also see that it's already moved off the bottom and has started to move up. So the other insight today is that mortgage rates are at low rates, number one, and number two, they're not likely to stay here that long. So the time to act is now. Now, a lot of people say, well, Joe, here's the deal. 4.5, 5.5, what's the difference? It's still historically low rates. Okay, well, let me show you what that means to your buyer. Number one, on a $150,000 loan, it's $91 a month, 1% interest rate. 250 is 151, 350 is 211, $450,000 loan, it's $271 a month. We're starting to talk about real money, and on a jumbo, it's almost $400 a month. So the insights I want you to take away from today is, number one, the Fed funds rate does not drive mortgage rates. Number two, we can expect more of the same, which is volatility. And right now, we are at the bottom of the interest rate market, and now is the time to act. And number three, if rates go up, it's going to cost your buyers more money to buy the home over the long run. What does that mean to your sellers if you have lots of listings? Well, that means the buyers are more likely to negotiate harder for a lower price because they're trying to get their mortgage payment in line. So here's what I suggest you do. Use these slides. I would be happy to send you PDF copies of them. Just reach out to me, Joe Trovato at Anchor, J Trovato at anchorfunding.com. corp.com, or just call me directly on my cell phone, 404 375 0779. I hope this was helpful, and I look forward to your comments and feedback. Have a great day. Go get 'em.